Lyn, welcome to the show.
Hey, thanks for having me.
So, Lyn, I've been following your work. I've seen you've been writing about Bitcoin and saying some very intelligent things. And I know you sort of shifted your opinions a little bit more recently in this year. So, let's hear a little bit about you and your story with Bitcoin.
Sure, yeah. So I come at this from a broader investment perspective. So I have a research firm, and we cover a variety of asset classes, including equities, alternatives like commodities, precious metals, occasionally fixed income, and I cover digital assets, notably Bitcoin, a handful of times. I originally encountered it back in 2010 or 2011, and I thought it was neat. I didn't really think about how to price it or anything. I didn't look into it too deeply. And then it was during that 2017 bull run where I started to get more and more emails from people as it kind of reached the mainstream. And so I dedicated a long form research article into Bitcoin and to some extent into the broader digital asset space, just because that was also the season of altcoins. And so my approach back then, that came out, about November of 2017. And so, Bitcoin was in the, about $7,000 range at that point when I wrote the article. Of course, it went up like $1,000 in the course of writing the article. And so my conclusion at the time was that, the technology is very interesting, and I can see why a lot of people like it. However, I didn't allocate capital to it because I was concerned about some sort of dilution. So that was, we had the Bitcoin and Bitcoin Cash fork, and I said, okay, so all of these are scarce. So Bitcoin's scarce, but what if all the money that pours into the sector just goes into all these different protocols, and there's not one protocol that's able to have a strong enough network effect to maintain like a dominant market share. And so I had some concerns about that. And also just, that was after many, many months of strong bullish accent. So I was worried about the overall euphoria and sentiment. And so I took no position. I said, if people want to have a small position, I think it could make sense. But, at the current time, I'm not. And so, fast forward, of course, we had a blow off top and then a crash and a multi-year consolidation. And I kept monitoring the space to some extent, and because I'm interested in it, but I never really took the time to go another layer deeper and to keep examining it. And roughly in late 2019, I started to dig a little bit deeper, and I was kind of thinking about building position if there were to be corrections or things like that. And then once we had that sharp correction in March of this year, I got quite bullish, and that's also when I went into the rabbit hole a little bit to find out more details about the protocol, including some things I didn't fully grasp in my 2017 research piece. And so I went long in April, and then I continued also looking more into it, increased my allocation, and wrote a number of articles about it. A big public one in July, and then a follow up here in November. And so, overall, it's been as I learned more about it, I became more bullish on it. And I'd say the one reason I became so bullish is that a lot of my concerns about 2017 were addressed. Bitcoin proved that it had a dominant network effect compared to all those other digital assets out there. And it has a security advantage, it has a network advantage, and so I felt that it was significantly de-risked enough. And ironically, it was about the same price when I went long in April as it was back in November. So I got my first coin for, it was like 6,900. So I was like, okay, it's the same price, but it's de-risked. So I'm more bullish now.
Yeah, that's a really great way to put it because many people who, in the recent, we're talking about the March crash down to kind of 4,000 range or so. At that time, it was a really interesting marker, if you will, because a lot of the people who weren't so in the know were like, "Oh, see, it's all dead, it's all over," and like almost everyone who was in the know was like, "I am trying to accumulate. I'm so incredibly bullish right now." So, what was your perspective there at that time when Bitcoin was crashing from, I can't remember the exact number, but it was something like from around 10,000 to maybe 4,000 or so in March 2020. So, what was your thinking there?
Yeah, so because I have experience with the gold market, I see gold behave similarly during those liquidity events, of course, less volatility. And so it's common during the early stages of a recession when you have a big liquidity crunch, right? So everyone, margin calls are coming in, people have to sell whatever they have. It's normal for even assets that theoretically should perform well in that environment to get sold off in the beginning. And then as soon as you get that liquidity response from the central bank and often accompanied by fiscal spending and other sort of policy response, that's when you usually get the sharp rebound in many of those assets like gold. And so you can see the same thing happen in the early 2000s recession. You could see the same thing happen to gold in 2008. And so I view basically Bitcoin as behaving similar to the metals were. And in particular, I mean, silver got crushed around March as well. And I was very bullish on silver. I mean, that fell all the way to like $12 an ounce. And so I was quite bullish on gold and then even more on silver. And that, I viewed Bitcoin the same way. So I was comfortable investing into a liquidity issue because I knew that there'd be a policy response. And also, I mean, I caught the rebound. So, it went down to something like 4,000 and then it was sharply coming back up. And that's when I said, okay, we're definitely in the rebound phase here. And I was pretty bullish at that point.
And that's one of the really the hardest things to do as an investor is to be actually buying when there's blood in the streets, right? Everyone can talk about it, but in practice, achieving it and doing that is actually the part that takes some real skill, wouldn't you say?
Yeah, I think so. And at the same time, there's if you're it's almost like a trap because a lot of people are afraid to buy when there's blood in the streets. But the types of personalities that, for one reason or another, are more value oriented and they're more likely to be able to, do that. They often have a tendency to sell too early, right? So now we've had a giant gain, and so I had to resist the temptation. Like, okay, I got a double. Like, should I just unload my coins now? And so I haven't sold a single coin, but I also publish research for other clients, and they all have different risk profiles. And I would explain like, okay, we've double our initial investment. Depending on how much people put in, I can see they might want to rebalance. But me personally, I don't plan on selling at this point, just because I don't think this bullish run is over. I'm still very bullish long term on the asset class, and of course I don't want to have taxable events or anything like that. So, I think it's always kind of tricky to keep holding, even when you have that kind of contrarian mindset.
That's a great point. And historically, there were many people who maybe they bought some Bitcoin at $1 and then they sold at $10 and they're thinking, oh, wow, I got a
Yep.
10x. But then they missed out on this huge, huge gain that came
Yeah.
afterwards because, again, they hadn't really peered into Bitcoin to understand what it is and what kind of market it's actually competing for. So,
Yeah.
Lyn, when you are thinking about what kind of market Bitcoin is competing for, how are you thinking about that?
So I've seen a lot of different people in the community all explain their own views of it, and so I start from the perspective of digital gold, because that's already a very large addressable market, right? So gold has a market cap, depending on the price at any given day, of in the ballpark of 10 trillion. And even the part that's for private investment purposes. So if you factor out the central bank and the jewelry component, there's still trillions of dollars of gold investment. And so I, even if Bitcoin is only digital gold, it can still, go up multiple times over. And then if I think beyond that, I do, there are arguments for it could be much larger than gold because, it fixes some of the issues that gold has. For example, it's verifiable, it's more portable. So, if it were to expand beyond that, I think there's a case to be made for that. But, I focus on, maybe one or two halving cycles here, and so I want to see how it performs, in this particular bull run, and I want to monitor it over time. So I'm starting from that perspective of primarily emphasizing its store of value, and that's also another shift I had from 2017 to 2020, because in my 2017 article, I was examining it both as a medium of exchange and as a store of value because they were kind of competing narratives at the time. And so my conclusions back then were that as a medium of exchange, it's probably overvalued. And I showed different quantitative reasons why. But I was like, okay, but if it were to have a rapid adoption, it could justify its price. But it's basically like a growth stock, like it's priced as though it's going to be more adopted. But then as a store of value, even back then, I compared it as a market cap to gold. And I said, okay, if it takes 10% of gold's market share, if it takes 50%, then you can get some pretty bullish numbers here on Bitcoin. So even in my 2017 article, I looked at the long-term potential, but I was kind of torn between narratives and, like I said, concerned about the network dilution. And so in 2020, with those risks addressed and emphasizing the store of value aspect, above all, that's what made me kind of quite bullish on it.
Yeah. And also, I notice as well, because you're interested in many different assets, right? You're not a Bitcoin specialist. And so there's a difference there in terms of knowledge, but then also in fairness, the Bitcoin specialists tend to be more permeable. And so, how do you think about that kind of when you're approaching the world and the way you're analyzing things is, not necessarily a Bitcoin specialist.
I think it can add a degree of objectivity. I've kind of used that before when analyzing the precious metals markets, because those can also be quite emotional markets. There are some people that are perma bulls on gold, for example. Whereas I sold my physical gold in 2011, and whereas a lot of bulls at the time kept holding and holding and holding. And so basically, for me with different asset classes, I'm a very long-term holder, but I still don't mind saying, okay, I'm bearish on an asset class over a multi-year period for reasons X, Y, and Z. And so by being able to kind of find value in different asset classes, I think one of my approaches with Bitcoin was I basically tried to take what some people were saying within the community and explain it to people that maybe were not in the community. And coming from someone that kind of approaches multiple asset classes, it turns some people onto it that might not have otherwise seen it. And I think that's kind of my voice in this space, is basically say, without blinders on, what asset class am I bullish on? What asset class am I bearish on? And looking out at the long term, I'm quite bullish on Bitcoin. And occasionally, like for example, back on uh, November 22nd, I part of a research note, I warned to my investment clients that probably Bitcoin is near term overbought, and I'd be actually welcome to see a correction here. And so we got that Thanksgiving little sell off there. But I mostly did that for, explain to them that I'm not selling any Bitcoin, I'm not trading around that view, and I just wanted to set expectations so people know how to handle that turbulence. And so I think having that multi-asset kind of approach can help people kind of navigate these markets a little bit.
For sure. And I think it's also historically true to say that during these bigger bull cycles, there are often these little 30% pullbacks along the way. So I suppose that's something you must have also been looking at, right?
Exactly. Yeah, I showed them the 2016, 2017 charts. There were multiple 30, 35% pullbacks. And, I don't know if this particular run would be quite that volatile, but it's certainly possible that it will be. And so basically what I emphasized was, I showed a bunch of metrics. There's all sorts of different kind of valuation metrics like, market cap over realized cap and all sorts of different things. And I showed basically in that November 22nd piece that sure that, more and more indicators are showing kind of near term, multi-week, probably overbought, but there's still nowhere near the type of euphoria we saw in, say, late 2017 or the previous kind of major halving cycle peaks.
Hmm. And also in some of your recent articles, you've commented on some of the different misconceptions about Bitcoin, one of which was energy usage. So how do you answer that question when someone says to you, Lyn, maybe Bitcoin's interesting, but look at the massive energy use it takes?
Yeah, so I learned a lot from people in the industry, because there are of course people that are specialized in that and they know way more than I will. And so what I wanted to do was kind of summarize some of the misconceptions about Bitcoin, as a non-expert and but from my deep research into it, and take that and apply that to some of the common criticisms. And so with energy, I point out a couple things. One is that anything of value generally requires a lot of energy, especially if we're talking about a decentralized store of value. So gold, for example, requires a massive amount of energy to get every single ounce of gold coin. You have to remove literally like tons and tons and tons of rock to get a gold coin, plus all the logistics, plus all the transportation, all the verification, plus the putting it into its final form. And so that's a very energy intensive industry. Of course, the energy is more front loaded, but it's still a very energy intensive industry. And so my point was that sure, Bitcoin uses a lot of energy, but that energy goes into its hash rate, goes into its security, and is what separates Bitcoin from most other stores of value, and especially from other alternative digital assets. And so basically, it was saying, okay, it consumes a lot of energy, but you can make the argument that this asset makes that energy worthwhile because it gives people options they didn't have before. And so there's kind of that, the market currently is saying that it's worth that amount of energy and that it's willing to put that energy into it and that there's a demand for that energy. The second one was, going along points that people make that Bitcoin really kind of optimizes to find cheap energy or stranded energy, or anytime there's an overproduction of energy in an area, Bitcoin can kind of arbitrage on that. And an example I was familiar with basically is that, I believe it's Iceland that has really low energy costs, and so they arbitrage that by, refining a lot of aluminum because it's a very electricity intensive process. And so they basically said, okay, we have this resource, and so we're going to put it to use in this way. And we're basically going to export our energy, our electricity cheapness in the form of our aluminum refining. And so Bitcoin's kind of similar in that, if there's, overbuilt hydroelectric dams, or if there's stranded oil and gas, like some people in the industry specialize in, those resources can be put into Bitcoin. So I didn't really have a problem with the amount of energy usage as part of my bullish thesis.
I see, yeah, and I think it could also arguably be said that as many governments around the world are subsidizing renewables, then in some ways, people who are able to use renewable to mine Bitcoin are kind of
Yep.
sucking up that subsidy. So there's a bit of an
Yep.
arbitrage there, wouldn't you say?
Yeah, I think so.
Yeah. Um, I think the other big question that many people coming in is around volatility, right? So they'll say, "Oh, look, it's it can go through these crazy swings, and in the space of a few months, it can it can 10x or whatever, and then it can drop heaps." What do you normally? How do you think about that when thinking as an investor there?
Yeah, so I define it as an emerging store of value. So instead of being an established store of value, like say gold or treasuries or whatever the case may be, Bitcoin is an emerging store of value. So the idea is not that it's currently a store of value in the sense that an investor can put in money into Bitcoin and expect that it'll be worth the same amount 6 months from now when they need that for a down payment. So it's not a savings account in that sense. But an analogy I've made is that if you look at equities, right? So if you have a blue chip stock, it's been around for 50 years. It's still valid. Pays good dividends. That's a stock that's a decent store of value. It's something you can put a lot of money into. You don't have to worry about it too much, especially if you have a diverse basket of companies like that. Whereas if you have a small growth stock, it's going to be more volatile, but then you have more potential from it because you're pricing in the potential future, which might not happen. But if you think there's a high probability it happens, you're basically pulling forward some of that value. Now, with Bitcoin is tricky because unlike an equity like a growth tech stock, Bitcoin advertises itself as a store of value. And so there's that little bit of a competing narrative about the volatility. But if you just kind of take a step back and say, okay, it might not be a store of value yet in that sense, it's an emerging store of value. So if people are correct about all the different bullish potential of Bitcoin, then it will grow into being a store of value. And in the meantime, that volatility, if you're right about the general direction of it, is more than a store of value because it's a growth of value. It's a multiplier of purchasing power rather than merely a maintainer of purchasing power like gold generally is.
Right, and probably similar. I guess gold is kind of like seen maybe more like a blue chip, whereas Bitcoin is more like the
Yeah,
growth stock in that kind of
exactly.
analogy.
Yeah.
Yeah. Um, and also in your writing, I've seen this kind of explanation of perhaps the phenomenon of Bitcoin, right? So you talk about this idea of the constant low key influx of new capital, right? Because all these people are, as we say, stacking sats. And at the same time, there's a reduction in the supply. So what are you getting at there with that dynamic?
Yeah, so I brought in some of the charts in my article. I referenced some of the charts from Plan B, the well-known stock to flow model. And so my approach with that model was, I didn't have an opinion about the accuracy of the forward projections of the price. I kind of disregarded that part of the model. But what was valuable to me were the quality of the charts that linked the price of Bitcoin over time strongly to the halving cycle. And in addition to just looking at the mathematical correlation of how that works out, basically the whole idea is, roughly the first 2 years of a halving cycle are pretty bullish, whereas, the next 2 years of a halving cycle tend to be more about consolidation and kind of finding a balance until the next halving period happens. And so I kind of stepped back and just logically, did some thought experiments and show, okay, if you have a set number of coins, if new capital wants to come in regularly, but then you have a reduction in new coins, you can easily see why the price goes, pretty parabolic during that time. And so even with pretty benign assumptions about how much demand has to come into the space, if you have a situation where a lot of the initial holders are not selling, and there's a decent amount of constant demand coming in, you can get a pretty strong price rise just from that supply reduction. And then of course that also triggers, more demand to come in because then they're excited about the price performance, and that's why you tend to overshoot, uh, you know, the model each time, is because you get that kind of blow off top of momentum and FOMO traders coming in. And so it's basically just an extraordinarily powerful incentive mechanism because it's fully transparent. So we all know it's going to happen, but until there's actually that kind of liquidity squeeze, and more people want coins than are easily accessible from, like, call it weak hands or traders, whatever the case may be. It's not until that happens that you get that kind of really strong bullish action.
Right. And to the point that you were mentioning there about those people who are accumulating and not selling, I think Bitcoin is also fascinating as well because people are able to do these kinds of on chain analytics to see,
Yeah.
okay, number of coins held more than 1 year or 2 years. And those actual metrics can give some level of insight as well. I'm not sure whether you've looked into any of those or that those have been a part of your analysis.
I have, yeah. Like when I was, researching the halving cycle, you can see, the percentage of coins that are held for over a year or over 2 years tends to follow a certain pattern along with that halving cycle. So, it tends to build up during that consolidation phase where you get a lot of those hodlers just kind of holding onto their coins, just still accumulating, and you have that kind of rise in the percentage of coins that are not really moving. And then during those massive bull runs, that's when you see some percentage of those hodlers start to take profits. So you have people, they might have been holding for a year, 2 years, 3 years, and they start to sell into some of that bullish strength. It could be for a variety of reasons. Maybe Bitcoin's becoming a very large share of their net worth, and so they want to, take some gains. Maybe they want to buy a mansion with their gain, whatever the case may be, Lamborghini. So for whatever reason, they sell into that bullish strength, and that's what creates some of the liquidity until you eventually have a blow off top. So I've found a lot of the on-chain metrics to be extraordinarily useful because I approach things primarily as a fundamental investor. And so I know people that use technical charts for what Bitcoin's going to do, whereas I prefer viewing the fundamentals. So, who's buying, who's selling, what are the mechanics of, what makes them want to buy and sell, and what are the use cases. So I like the fact that it's very transparent.
Yeah. And speaking of transparency, I think another interesting theme is this whole idea of concentration of Bitcoin, right? So people come out and say, "Oh, look, the Gini coefficient of Bitcoin is, or it's so highly concentrated." How do you think about that issue?
Yeah, so I had a tweet that went kind of semi-viral around that subject, which was, people were pointing, there was kind of an influx of tweets I saw about how concentrated it was. So I just pushed back a little bit and showed how concentrated the US stock market is. And so it is true that, as far as we can tell, Bitcoin is pretty concentrated. Now that's still an estimate because, you're looking at the number of addresses and, all that. So of course, one big holder can have multiple addresses, and one big address can be a custodian from multiple smaller holders. But as a general, estimate, we know that it's fairly concentrated, but it's, comparing how vastly concentrated the U.S. stock market is, it's really not that much different, especially considering that the U.S. stock market is so much bigger. We'd expect it to be more, kind of spread out, but it's not. So, for example, the top 10% of holders of the U.S. stock market hold 88% of it. And then the other 12% is held by the other 90% of people. And so it's extraordinarily concentrated. And if you think of Bitcoin even further as, a fairly young tech stock, right? So, it might still have a lot of insider ownership from some of the initial founders, from some of the early investors. So it's not like one of those stocks that's been around for 50 years that is like widely held. It's still fairly concentrated. So I think over time, Bitcoin can spread out more than it is now. But in the meantime, I'm not really worried about its concentration because you have kind of that same concentration effect in most other asset classes as well. And that does create some degree of when you get some of those brutal sell-offs, even within a bull market. Part of that is from the concentration. You have kind of whales coming in, taking some profits. But as long as people can put up with that volatility and don't lose sleep over week to week changes and talk about price manipulation and things like that, if you can kind of have a multi-year outlook, the concentration is probably not that big of a deal in my view.
Right. And I guess it just, like many other things in life, there's going to be an unequal distribution, and it's going to be power laws and Pareto 80/20, like many other things in life. Um, so I'm also interested to just talk a little bit more about kind of the like broader macro environment that we're in. So, people are faced with an environment of higher inflation, and they perhaps feel like they don't have as many options in terms of where they can put their money. So, why is that?
So there's a couple reasons. I mean, one, the challenging thing is I've written a couple notes recently about inflation, and the challenging thing is because there's different definitions of inflation, right? So there's, some schools of economics focus on the broad money supply, and so the broad money supply is increasing rapidly, especially on a per capita basis. Then that's inflation. It's already inflation, regardless of what prices are doing. And so, we can refer to that as monetary inflation. So, the broad money supply in the U.S. went up well over 20% this year, and so then there's other types of inflation like asset price inflation, which is when, normally when you have that kind of broad increase in money supply, that can pour into scarce assets. So whether it's real estate, equities, gold, Bitcoin, fine art, wine, fine wine, those things tend to go up very quickly, especially when you have a lot of wealth concentration in society. And so, most of that money gains are going to the top 10% or so, and then they're storing it in those assets. And then, of course, you have consumer price inflation can happen when the broad level of prices goes up. And we've seen over the past several years a lot of imbalance in there. So we've seen, things like healthcare, tuition, childcare services, uh, all those things have gone up very rapidly in price. Whereas things like electronics and other things have been more deflationary due to technology, due to offshoring, due to all sorts of different factors like that, due to demographics, even due to debt. So you can have that kind of deflationary offset. And so, Bitcoin as a store of value responds a lot to that monetary inflation and that asset price inflation, which, those are the numbers that are really big this year. And the reason they're so big is, the U.S. is running very, very large fiscal deficits. And then importantly, rather than extracting that capital from, say, issuing bonds that people buy, right? So if you were to run deficit, there's basically a couple different models of government financing. So you can tax from one part of the economy and spend it in another part of the economy, and it's just kind of a rearranging of what's happening. Then you can add, debt to that. So you say, okay, in addition to taxes and spending, we're also going to issue treasury bonds, extract capital, from volunteers that want to buy those, and we're going to also put that somewhere in the economy. And again, you're just kind of rearranging things. However, when you're running large deficits, that the central bank is printing new dollars to buy those treasuries, that actually directly increases the broad money supply far quicker. And so by law, the Fed can't buy directly from the Treasury, on an ongoing basis, but they can buy through the primary dealer banks. So basically, the Treasury can issue tons of treasuries, banks buy them, and then they sell them to the Fed. And the Fed just creates new bank reserves out of thin air and uses those to buy those treasuries. And so you basically have indirect deficit monetization, and that's a key part of kind of most structural inflation trends.
I see. And so, in your view, then, is it mostly an American story or a US story about people wanting to buy Bitcoin, or are you seeing a case there for people in other countries around the world also?
It's pretty widespread. So, I cover something called the long-term debt cycle frequently. That was a topic that was popularized by Ray Dalio, and it's something I've done a lot of additional work on. And that's the idea that, as it's kind of basically within the Keynesian framework we have, where you have when you have a business cycle, right? So you have a recession, and then you start to get, a deleveraging event. That's when the government comes in. The central bank cuts rates, the government does stimulus spending, and you stop that deleveraging about halfway through, and then you start building up leverage again. And so if you string multiple of those short-term business cycles together, you're never really deleveraging all the way back down to where you're starting. And so after 5, 6 business cycles, you get higher and higher debt as a percentage of GDP, both in the government and the private sector. At the same time, interest rates are hitting lower and lower levels each time. So they're able to raise them a little bit during the expansion, but then they cut them during a recession, and they never get back up to where they were in the previous cycle. So you get higher and higher debts, you get lower and lower interest, and that lower interest allows all those entities to hold more and more debt relative to income, relative to GDP. And then that party kind of stops once you hit the zero bound, because you can't realistically cut interest rates much deeper. Some countries have gone mildly negative. You need basically to eliminate cash to be able to go deeply negative, and so they turn to asset purchases and deficit monetization instead. And historically, once you hit the zero bound, that's when you get, in the decades that follow, you eventually get some sort of currency devaluation, and that's basically how you end up deleveraging the system. So instead of deleveraging nominally by, defaulting or paying back the debt, a lot of it gets partially inflated away. So the money supply goes up a lot quicker than the debt, and eventually they start the whole cycle anew. And so that's something that is happening in the United States, but it's also happening in much else in the developed world. So, we have a ton of debt in Europe, we have a ton of debt in Japan. China's, private sector is incredibly leveraged. And so it's mostly a worldwide phenomenon, more so in developed countries. But then, of course, emerging markets have their own problem because even though they have less debt as a percentage of GDP, the issue they have is that a lot of their debt is denominated in dollars. So their own government can't print that away. They can't. So that's why emerging markets tend to have more inflationary crises more often, and that's why they tend to default more because their obligations are often outside of the jurisdiction of their own central bank. And so, Bitcoin is very popular in certain countries that have currency failures and things like that, or even just, not even like a full failure, just like a constant loss of purchasing power. And so I view it mostly as a global story.
Yeah, that's a really interesting way to put it. And as you rightly point out, there are a lot of countries in the world who are not monetary sovereign, i.e., they are able to have their own currency and also borrow denominated in their own
Yep.
currency. And because of that, for example, somewhere like Argentina, who has to borrow in US dollars, that's what's creating a bit of this dynamic where
Yep.
they face higher inflationary pressure over time just because they can't manage it so well themselves. Whereas if you are USA, if you are Japan, you are in a different story. It's a different category. So bringing it to what people face, I guess we would say people face an incentive to go into debt, right? People face an incentive to go get a mortgage because over time, the value that you repay will be inflated away over time, such that the amount you're paying back in real terms is coming down over time. So it helps people who are in debt. So then, what does that sort of look like over time? Would we say that that's also part of the reason why we're seeing these huge housing bubbles because everyone is incentivized to go into borrow and buy a house, right?
Yeah, pretty much. I mean, that's what we saw to the buildup of the 2007 bubble. So after the stocks crashed, after 2000, they cut interest rates super low, and that helped encourage a housing bubble. Combined with banks it's not acting rationally and people acting irresponsibly. So that kind of policy that incentivized bad behavior combined with their willingness to behave badly can cause those bubbles. And more broadly, the way that the global monetary system is designed ever since the early 70s, ever since we went off the Bretton Woods system. Basically, every country's incentivized to have weak currency, right? Because they want their exports to be fairly competitive, and they want to have positive trade surpluses, and so a lot of these countries have mercantilist policies where they'll print money to buy more and more foreign exchange reserves in a specific attempt to weaken their currency. Now, of course, they don't want their currency so weak that it looks like an emerging market currency where people can't import what they want, but they basically want to have this constant weakening pressure on their currency. And you see this kind of over time. It's like a game of musical chairs where these countries are all have this incentive to do competitive devaluations with each other. And so right now, for example, China's running surpluses with the United States, Europe's running surpluses with the United States, and so they have this incentive to kind of keep their currencies, weaker than they should be based on a trade balance basis, because they want to keep that business flowing. And in the United States, we've been on the big trade deficit side of that. So ever since we went off the Bretton Woods system and onto the petrodollar system in the early 70s, we've had this gaping multi-decade trade surplus just because of how we structured the whole global monetary system, mostly based around energy pricing and just this big, weird incentive structure we've had for decades.
Yeah. And there are also some interesting or unfortunate consequences when governments go into too much debt, aren't there? I know you were also commenting about what typically happens once they get above a certain debt level, that it's difficult for them to come back down from that. There's what's the word? It's like a tipping point, right?
Yeah, event horizon. So the study I was referencing showed that, over the past 200 years, there were, 52 countries that went over 130% debt to GDP. And over the next 15-year period after that, 51 out of 52 of those either inflated away, defaulted, restructured it, or otherwise didn't pay all, didn't maintain the value of their sovereign bonds in purchasing power. The one exception was Japan, but they had some unique characteristics that allowed them to hold on to that longer than anyone else. So, for example, they have the largest net international investment position in the world. So even though they have high sovereign debt, they've ran decades of trade surpluses, and so they have a situation where Japan owns more foreign assets than foreigners own of Japanese assets, and so they have this constant stream of income flowing in from their assets around the world, and so they, plus their highly organized culture, low unemployment rate, they've basically been able to push that longer than anyone else. But generally, once you get above 130% debt to GDP, you generally start to see a degree of currency devaluations or default. And in the United States case, and of course that can take different. There's a spectrum of outcomes there. So you can have, on one hand, you can have hyperinflation, which is more often happens when you have external obligations, either war reparations or dollar-denominated debts. If you're Argentina, things like that. If you're a monetary sovereign, then you historically get kind of a partial currency devaluation. So the only other time in U.S. history where we had federal debt to GDP as high as it is now was the 1940s during World War II. And what they did was they employed yield curve control. So the Federal Reserve said, we're going to hold treasuries across the entire duration spectrum at 2.5% or below. So T-bills were held at like 0.38%, and the long end was held at 2.5%. And the Fed was able to maintain that peg by saying, we're going to print money and buy treasuries as needed to maintain that peg. And so even though inflation had these double-digit spikes in the 1940s, there are two spikes that got up into the double digits and another one that got into the high single digits, but they still held treasuries at 2.5% or less. And so anyone who held treasuries throughout the course of that decade, you made all your money back nominally, but you lost roughly a third of your purchasing power after that decade was over, just from a big chunk of that being inflated away. Because even though they can control interest rates, the release valve ends up being the currency itself.
Right. And so what's the implication there for, let's say, pension funds, investment funds, even insurance funds, when they are stuck in this environment where they can't get much of a return out of bonds? What are the typical valves or areas that they get pushed into?
Well, we've seen, more and more pensions get pushed into equities and pushed, further into the volatility spectrum, and private equity, even including, pensions that have been bag holders, some really bad kind of private equity, things like financing shale oil, whatever the case may be, just a bunch of uneconomic projects. And it's challenging for them because pensions have often had like a 7% return target, 7 or 8%, which could make sense if treasuries are yielding 5% and equities, you can expect a little bit more than that. So you can say, okay, with a balanced portfolio of equities and bonds, we can comfortably get 7 or 8%. But when you're in an environment where yields are near zero, and then stock valuations are consequently pushed very high, right? Because people are willing to pay up for stocks because they're, compared to the alternative of bonds. So you jack up the stock valuations and lower the forward expected returns. Then you're in an environment where all these, institutions have a lot of trouble getting that, return that they need. And, you can kind of have projections and say, okay, we can kick the can down the road and say, if we're optimistic about our projections, it looks good. And that's one reason they don't reduce their target returns, because if they reduce their target returns, then they basically admit they're insolvent. And so they have to kind of maintain the illusion of solvency by still maintaining these pretty high return targets that they often do not meet. And so it's historically very challenging. I mean, if this goes anything like history, bonds are unlikely to do well especially on an inflation adjusted basis. And so anyone kind of relying on them is likely to lose some degree of purchasing power. I mean, even in the best case, if you don't have kind of outright high inflation, if you just have, positive inflation while their yields are, through financial oppression, yield curve control, either formal yield curve control or informal yield curve control, you're just gradually chipping away your purchasing power. And that's on a best case scenario. If in worst case scenarios, you could have a spike in inflation while those yields are still held quite low.
Yeah, it's a very difficult situation. And as you point out, that when the world is in, even from a stock market perspective, if the valuations are already very high, then from a CAPE, cyclically adjusted price equity ratio, you can't be expecting really great returns to come from
Exactly.
stocks. So you're
Yep.
kind of stuck in this weird situation. But at the same time, you might be okay. You might be thinking, okay, yeah, we should buy some Bitcoin, but perhaps for some of these large entities, Bitcoin simply isn't big enough yet for them. At as we speak today, Bitcoin is around 350 billion as a total, kind of asset. And I guess what's your thinking around that, around the relative size of Bitcoin as a market compared to say gold or stocks or other investable assets?
I think that's absolutely right. And the funny thing is, I mean, even in that sense, gold isn't necessarily big enough, at least at current prices. And so, if you were to have a 5% allocation in gold among, institutions around the world, gold would have to be much, much more expensive. The market would have to be much bigger to be able to absorb that. So it actually still even underweight precious metals, which are historically one of the alternatives that can hold up if you want a somewhat more defensive asset in your portfolio in that environment of low real yields. And so, Bitcoin as a small fraction of gold's market cap has that problem multiple times over, which is tiny compared to that. And so, you kind of see it go up the ladder. So, Bitcoin used to be a retail phenomenon. Individuals kind of either developed it or found it, and it kind of went from the ground up. But then you have kind of adventurous institutions hop on board. So you had Fidelity hop on pretty early and start exploring it, and you have some family offices or some hedge funds. They're not managing, say, hundreds and hundreds of billions, and so they're able to be nimble enough, or they might have kind of quicker processes in order to employ their capital instead of a complicated kind of model. And so you kind of go up there, so you start to see some of those more nimble organizations hop on board, and as the market cap grows, then you can accompany bigger and bigger pools of capital that can potentially decide to have a non-zero Bitcoin position.
Right. And I think the other important part is just over time, as people become more comfortable with Bitcoin, they are more comfortable to up their allocation percentage. So at the start, people just they want to dip their toe in the water, right? Take a
Yeah.
small amount. And then as this thing grows, they're probably going to be more happy to hold a higher percentage, wouldn't you say?
Yeah, kind of like, gold, for example. I mean, today, if you have an investor interested in both gold and Bitcoin, they'll usually have more money in gold because, probably won't wake up tomorrow and gold's down 30%, whereas Bitcoin has a higher probability of something like that happening. And, so as people manage around risk adjusted, returns, they generally de-emphasize those more volatile assets. And so that leaves that can be good for people that don't mind that volatility, that don't have that mandate to reduce volatility as much as possible. And so, people that have high conviction, that have a long time horizon, they can overweight Bitcoin more so than some of those institutions can. And so, I think over time, if Bitcoin grows larger and it becomes less volatile, then I think you can see people put more of an allocation into it. It's also a narrative thing. So, for example, back when it was associated, people would associate with drugs or criminal activity. Some of those narratives are still around, you know, yeah, but I think as that kind of fades, and as you get the Stanley Druckenmiller approval stamp of approval on it, and you get the Paul Tudor Jones stamp of approval on it, then you can see more and more institutions kind of flood in, because they're not the not they're not the first anymore. They're not kind of risk being viewed as something that would invest in something illicit or something kind of dangerous, right? They're saying, okay, I mean, we're allowed to view it as an asset class now, and so you can start to have that floodgate open. And I think it was Neil Ferguson's article. We talked about Bitcoin, and he showed some of the back of the envelope math showing that if every millionaire in the world wanted to put 1% into Bitcoin, even that Bitcoin has to grow dramatically in order to accompany even that amount of allocation. And that doesn't even include the fact that non-millionaires want to hold it, and some millionaires might want to have more than 1%. So it's just basically the market cap is still tiny compared to the potential, if it continues to catch on and grow, and more people want to have a non-zero allocation.
Right. And as we've seen historically in Bitcoin, it has tended to move in these, well, historically 4-year cycles. Do you have any thoughts around, how big this cycle could go in terms of adoption? So not necessarily talking about like what price or whatever, but more just like how I guess, well taken up do you think it will be in terms of percentage of the population, as we say, over this next few years?
I'm not sure about percentage of population, but I think, I don't think, for example, to reach like the broad pension level in this cycle. I think, I think kind of the adoption you're seeing now, where you're getting more mainstream interest and you're getting a variety of funds, like especially hedge funds and things like that, that are on the more nimble side of institutions. So I think that's where this cycle ends up is, kind of the faster money gets in and is able to get pretty in. I'm curious to watch Google Trends because, we saw during every time there's been a previous kind of cycle peak for Bitcoin, there's been a spike in Google Trends searches for it. And of course, the 2017 spike was massive because that's the one where it really kind of hit adoption. And we're still not seeing one of those. We're still not seeing one of those search spikes yet. And that could be because enough people, already figured it out from the last search, and so they don't need to search again. But at the same time, I mean, I still get questions from clients like, how do you buy Bitcoin, or what is the best exchange to buy Bitcoin, or so people still have to search for things like that if they go from having heard of it but actually wanting to own it. So you still should see an increase in search activity around certain types of terms, uh, and not just like a mild increase. You should see a spike similar to 2017. Now I've heard, I know some podcasters are reporting that their listens are going up, so it might also be the case that we've increasingly heard, instead of searching for it, on Google, people might be hearing it more and more from podcasts. So it's not a perfect metric, but I think, I'm viewing it more as kind of like what level of asset manager will it get to, and so I think basically we're at the level it's going to get, just more and more of it. So we have, some hedge funds flowing in, but I think by the end of the cycle you could have a lot more of that fast money in, as well as continued retail adoption.
Hmm. Yeah, I think very prescient comments there. I'm curious if you've got any views on, let's say, what kind of news articles or events happening over this cycle that might indicate to you that, okay, we're looking a bit toppy now, it's a little bit frothy. Are there any kind of ideas in your mind there in terms of what that might look like?
Some of the on-chain indicators are good, like realized value compared to market value. I think is a good one. Just basically once the technical signals are like extremely overbought, again, like Plan B has really good models showing, what is the relative strength index on a monthly basis for previous bull runs, as an example. So I would continue to monitor some of those euphoria indices. uh, Even in this recent kind of bull move and then correction, part of the reason I got a little bit cautious, wanted to make sure my readers were ready for a potential correction, was I started to see kind of a euphoric sentiment, at least within the community, right? So once you're at the point where you're comparing Bitcoin's market cap to JP Morgan, and you're also, you're touching new all-time highs. That's kind of a classic resistance level. There's basically a perfect storm of reasons to expect that we're going to run into some turbulence here, and so uh, that was kind of an easy call to make. But then, of course, the hard part is wondering how long would the correction go, how deep would it go, and that's why I didn't try to trade around it. I just said, just don't be surprised when we probably see one here. And so I'm looking at mostly in terms of how long we go, into this halving cycle. What does the price action do? What do some of the technical indicators look like compared to previous cycles? What do some of those fundamental indicators like market value versus realized value? And just kind of look for comparisons there. I don't really plan on trying to time a top, but unlike some Bitcoiners that say never ever ever sell, if it balloons to a significant chunk of my portfolio, I wouldn't mind, explaining to people that, they all have their own risk tolerances, and so that I do think it is getting frothy here, and that, people can, interpret that however they want for their own situation. It could, implying that you're in for another multi-year consolidation, which some people wouldn't mind holding through, whereas other people might not want to see their gains, go down 50% and consolidate, and so they might want to shift profits and just kind of rebalance their risk profile.
Gotcha. Yeah, for sure. And I think there's also a change in the narrative as well. So as you were pointing out, uh, in 2017, it was a mix of, people who are confused about Bcash and medium of exchange versus store of value. But I also think in this coming run, or this run that we're kind of going into now, I think there's also more of a narrative around regular accumulation, right? Dollar cost average, stacking sats. What kind of an impact do you think that will have if more and more people are just every week or every month or every day, even just buying a bit.
That's good. I mean, that can smooth out the volatility, and that's, in addition to the larger market cap, I think that's one of the reasons why you could potentially see, even though you still see a lot of volatility, I think there's a case where maybe you'll see less volatility as this grows, because as more and more people, they look, the more kind of price history you have, the more people are confident to accumulate into it. And so, even in my own outside of Bitcoin, I often promote the idea of dollar cost averaging into other investments, and that's even though we sometimes rotate capital from one type of investment to another type of investment. I still think the general idea of dollar cost averaging into your net worth is a good idea, and so that's why, for example, I've associated myself with Swan Bitcoin just because they emphasize that dollar cost averaging rather than that, like, trading casino altcoin mix that a lot of people kind of fall into when they enter this space.
Absolutely. Yeah, I really like what Swan are doing. They are a sponsor of my show also. So certainly, I think that is an important message to carry with us as we're kind of going through this, such that people aren't thinking of trying to like become traders, because the reality is for most people, that's just not
Yeah.
realistic. Um, so, look, I think we're just coming up to the end of time. So, if you had any closing thoughts for the listeners, perhaps you could give us those, and also make sure you let the listeners know where they can find you online.
Sure. I think, it's going to be an exciting cycle, right? Because, every time Bitcoin has one of these, having events, and you've kind of held on through a consolidation phase and you start to retest new highs, it can be a really exciting time. And there's going to be volatility. And I think, one of the most important things is just kind of, keep an open mind to other people as you encourage them to, if you want to sell the asset class as an idea to other people, is to basically approach it from where they are. So I think, some people have kind of a harsh attitude, which I love to see in some ways because I love the enthusiasm. But I think, also, if you have kind of a way of approaching people that, can kind of speak to them in terms they understand, I think it can go a long way to showing them kind of the value of having that asset class, in their portfolio. Why they might want to have a non-zero Bitcoin position, as I often say. And so I think it's just going to be a really interesting cycle to see if it plays out like some of us expect. It's going to open a lot of questions in people, and so it's best to approach them kind of humbly and just kind of being willing to answer any questions they might have. And for me, I can be found at lynalden.com, and I'm at Twitter at Lyn Alden Contact.
Fantastic. Well, Lyn, I've really enjoyed chatting with you. You've certainly had a lot of interesting insights to share. Thank you for joining me today.
Yeah, thanks for having me. Happy to be here.